And would like to understand from you on 2-3 areas. So the one is that what are the issues surrounding loan pre-sanction in co-lending, and how can they be addressed? So the pre-sanction at the time of pre-sanction, what are the issues which are to be considered, and how they can be addressed? Another area is that how can banks and NBFCs ensure co-lending arrangement that it is transparent, fair, and free from any challenges, the wrong lending practices. So, sir, over to you, and thank you very much, sir.
Because you see, for the banks, 2-3 things are absolutely necessary. Number one is that you have to comply with the regulatory prescriptions regarding priority sector lending. Number two is that financial inclusion is now one of the most important or focused area of the government of India, and as PSU bank, you need to implement it. So these two are the major drivers, and co-lending process is a model whereby each one of us is just trying to leverage the other strength. Now, if you look at what are the other strengths, so for the banks, the strength of the NBFCs are, number one, they have a much wider outreach compared to the banks. Number two is that their credit process is quite faster if you compare with the system that are being followed at the banks, because these are all legacy problems which we are still continuing and need to revamp and change a lot. Gradually it is happening, but definitely the NBFC, especially the new ones, which have come with a lot of robust technology, they are quite ahead in this front in selecting the customers and making quicker decisions. The third is the collection mechanism also. If you look at the collection mechanisms, I feel that the NBFC's collection mechanism is, I would say, is much better than that of the PSU banks. There are many reasons behind it. And the first major thing is that you see, as a PSU bank, you cannot have the time because there's so many things you have to do, the recovery and follow up everything. The adequate time is not given. So that definitely we can take the strength of the NBFCs in this regard. And for the NBFCs, the greatest strength is that their resources. Because banks have almost, I can say, unlimited resources, huge deposit base, huge liquidity, and getting a direct loan for the bank and then again on lending it for some purpose is a time-consuming process, requires a lot of credit appraisals, requires also the sector-wise, also the segment that should not be breached. So many other criteria are needed, which can be obviated if we go through the co-lending model. So co-lending model, I can say, is definitely one of the best models that RBI has introduced. And there are definitely certain initial hiccups. The initial hiccups, the first thing is that if you look at the model, so first criteria is that the bank and the NBFC board should have a board approved policy. Now the synchronization does not come in this policy making only. So if you can remember that in IOB also, we started with some policy. Then we found that the business is not coming because it is not synchronized with the trend in the market. And then we subsequently made the amendments, and then only we can get the business from the NBFC. So that is very important from both sides, whether it is from the bank side or whether from the NBFC side. And now the selection, and in this master policy also, or the board approved policy, I think it is better to have a round of discussions with the various banks, because with the banks, you can already have a discussion, and both the banks and the NBFCs can let down the basic principles of selecting a borrower. These are very, I would say, poor people, or they are, I would say, the most needy people who do not actually have the courage also to visit a bank branch, but they are being marketed by the NBFCs. So we should have a very simple risk analysis model. The risk mechanism model should be very simple, based on the track record, based on their civil scores. Many of them may not have also civil scores also. So that also we need to obviate for that year. So if obviously based on the track records and based on the experience, we need to devise a proper risk model so that at the first sight, when you are taking up the proposals, the borrower is accepted to both the banker and the NBFC. That simplification is needed. What we find is that in many cases, we are unable to grow, our bankers are not able to disburse the funds because bank's criteria is quite different than that of the NBFC criteria. So we need to synchronize on this front so that we can have the NBFCs right from the beginning and their borrowers right from the beginning, and we can smoothly process the loans and disburse the loans. That is one which is absolutely needed. The second thing I would say is that there are certain issues between the banks and the NBFCs, and the most important is the technological synchronization. So each bank has its own systems and softwares, each NBFC has its own systems and softwares. So integrating these two systems is definitely a challenge. So till such time, I would say we can go to the second model, that is whereby we can fully buy out the assets of the NBFCs, and NBFCs can sell their assets. And so the second model, which is almost similar to the securitization or the direct assignment, that is more important, and we can go through it and we can push this through before we can come to the first model where a sharing of the loan can happen, because that has some challenges. Yes, definitely. One is the TDS challenge, where the NBFC has to give, the banks don't have to give. Number two, the appropriation of the various charges, that is also a challenge. And more so, the data sharing through the two systems. It should synchronize and it should come a common data for both of them. So works are going on. I think now everyone was just saying that CLM2 has found out some solution in this regard. So going forward, we can also think that, yes, we can have a proper technological solution to this process. But till such time, I think the second model of full financing or second model of direct assignment that we should promote, because the minimum holding period is not required. And in this, through this model, we can actually promote the co-lending model for that year. And as you have said, the 25,000, the market is much more. It will soon beat 1 lakh crore. I have no doubt on it, because now all banks are participating. As I've told, that they need to fulfill the regulatory prescriptions, and they need to also support the Government of India financial inclusion drive. So there is an ample opportunity for both of us. It is a very profitable model. And to the borrower, the best thing is that their one point contact is the NBFC, but they get the benefit of the blended interest rate. That is because the bank's interest rate are definitely less, and the NBFCs, which are comparatively more, but when they're blended, it is an advantage to the borrower. So it is a win-win situation for all three of us. That's all. Thank you.